America did not arrive at the edge of financial instability by accident. It arrived there through success. For more than half a century, the United States built the most flexible, adaptive, and powerful financial system the world had ever seen. A system capable of absorbing shocks, recovering from crises, and extending growth far beyond what older economic limits once allowed. Debt was not treated as a flaw. It was treated as a tool. Every recession was met with intervention. Every slowdown was softened with credit. Every crisis became proof that the system could be stabilized again. And for a long time, that belief was justified. But over time, something subtle changed. Debt stopped being a temporary solution. It became the foundation. Today, America does not borrow only to overcome emergencies. It borrows to function. This is not a political argument. It is not a conspiracy story. It is a mechanical story. Incentives, balance sheets, and the quiet ways a system rewires itself when the same fix works one too many times. In part 1 of this series, we showed how the modern system learned to expect rescue. In part 2, we are going deeper, how that expectation turned into a debt machine, and why the machine now creates fragility, even while everything still looks normal. Because the most dangerous phase is not the crash. The most dangerous phase is the period when the machine is still running, but the margin for error is gone. Section 1. When debt was a bridge, not a lifestyle. In the decades after World War II, debt had a clearer purpose. The United States was rebuilding industry, expanding suburbs, and investing in infrastructure. Borrowing funded factories, highways, research, and housing. Productivity rose, wages rose. Income growth created a natural ceiling for how much households and businesses could safely owe. Debt worked because it was tied to something real, rising output and rising ability to pay. A family took a mortgage because the paycheck could support it. A business borrowed because expansion would create revenue. Government debt climbed during wars or recessions, then came down as growth returned. There were also cultural limits. Failure was allowed. Overextended companies could go bankrupt. Over-leveraged investors could get wiped out. That pain was part of the system's discipline. The result was resilience. The economy still had recessions, but the structure could recover without needing larger and larger doses of support every time. Then the world changed, not overnight, quietly, and in a way that felt like progress. Section 2. The shift to elastic money. In the early 1970s, the United States moved away from a money system anchored to gold. Without that anchor, money became fully elastic. Credit creation was no longer constrained by a physical limit. It would be constrained by policy choices, financial regulation, and, most importantly, confidence. At first, elasticity looked like freedom. The system could respond faster, liquidity could be injected, the economy could be smoothed. And because the United States issued the world's dominant currency, global demand for dollars helped absorb the expansion. But elasticity changes behavior. If money can expand, debt can expand. If debt can expand, the cost of mistakes can be delayed. And when delays work, the system learns the wrong lesson, that consequences are optional. This is where the machine begins, not as a scam, not as an evil plan, as an adaptation to a world where the easiest path is to borrow today and deal with the bill later. Over time, growth became harder to generate through productivity alone. Manufacturing share declined, wage growth slowed, yet expectations did not slow. People still wanted the same lifestyle, the same asset appreciation, the same upward trajectory. Debt filled the gap. Section 3. How crises rewired incentives. Now look at the crises that shaped the modern era. The stock market crash of 1987 taught policymakers a lesson. If panic spreads, you can stop it with liquidity. The system survived. Markets recovered. That success mattered. The dot-com collapse taught another lesson. If asset prices fall, you can cut rates and restart the cycle. The system survived again. Then came 2008. And 2008 was the moment the debt machine became structural. The response to 2008 was not just a rescue, it was a template. Rates went to the floor, extraordinary lending programs expanded, central bank balance sheets grew. The goal was survival, and survival was achieved. But survival came with a side effect. It trained everyone to expect support when the system is under stress. If you are a bank, you learn that liquidity will appear when markets freeze. If you are a corporation, you learn that refinancing will be available when credit tightens. If you are an investor, you learn that extreme volatility will trigger intervention. This is not about morality, it is about incentives. When the downside is softened, risk expands. When the pain is delayed, leverage becomes easier to justify. When people believe the system will be stabilized, they build strategies that only work if stabilization continues. That is how you turn a financial system into a machine that depends on debt. You make debt the simplest solution to every slowdown, and you repeat it until it becomes the default. Section 4. The new business model. Borrow to buy time. Here is a key shift most people miss. In an older economy, borrowing was meant to finance new production. You borrowed to build something, sell something, or create something that would generate cash flow. In the modern debt machine, borrowing increasingly finances time. Governments borrow to maintain services without raising taxes enough to pay for them. Corporations borrow to repurchase shares, to roll over old obligations, or to meet expectations of constant growth. Households borrow to cover gaps between rising costs and stagnant incomes. Debt becomes the mechanism that keeps the present stable, not the mechanism that builds a stronger future. And the machine gets stronger because it looks like success. When borrowing prevents recession, leaders get praised. When markets recover after support, confidence grows. When asset prices keep rising, everyone feels wealthier. But the cost does not disappear, it compounds. Section 5. Why the machine feels safe until it doesn't. The most dangerous systems are the ones that feel stable. If you asked most people to describe a collapse, they would imagine lines at banks, riots, dramatic headlines, and sudden failure. That is not how modern financial breakdown usually begins. Modern breakdown begins with quiet adjustments, spreads widening, liquidity thinning, funding costs rising, and risk being priced differently, first in places the public does not watch. A bank run in the modern era may not look like people outside a branch. It looks like deposits slowly shifting to money market funds. It looks like large clients moving balances to safer institutions. It looks like institutions shortening duration, hoarding liquidity, refusing to lend except at higher premiums. The machine is still running, but it is running hotter. And when a machine runs hotter, small problems become big problems. Section 6. The interest rate trap. Here is the trap in simple terms. If rates go up, debt servicing costs rise. That hits households with variable loans, corporations with refinancing needs, and governments rolling over bonds. Higher rates tighten credit, growth slows, defaults increase. The system feels stress. If rates go down, borrowing becomes easier again. That may stabilize the short term, but it also encourages more leverage. Asset prices inflate. Risk-taking returns. The machine gets even more dependent on cheap money. Either direction carries consequences. That is what fragility looks like. A system where the tools still work, but each use creates new dependence. The debt machine does not collapse because rates move. It collapses because the system cannot tolerate reality for long. It requires a controlled environment, predictable funding, constant refinancing, and the belief that liquidity will be available when needed. When that belief weakens, the machine starts to malfunction. Section 7. The 3 hidden gearboxes: government, corporations, households. To understand why this matters, break the machine into 3 gearboxes. First, the government. Federal debt is not just a number. It is a structure of ongoing financing. Maturing bonds must be rolled over. New spending is often financed by issuing more. When rates rise, the cost of that rollover rises. When costs rise, fiscal flexibility shrinks, and shrinking flexibility makes the system more sensitive to shocks. Second, corporations. Corporate debt expanded dramatically over decades of cheap money. Many firms became dependent on rolling debt instead of paying it down. Some borrowed to invest, but many borrowed to maintain earnings per share through buybacks, or to acquire growth, or simply to survive in competitive markets. When refinancing becomes expensive or unavailable, the weakness appears fast. Third, households. The household sector is where the story becomes personal. Many families feel they are doing everything right, yet costs rise faster than pay. Debt becomes a bridge for emergencies, then for basics, then for stability. When credit tightens, the pressure hits daily life. Housing affordability, car payments, revolving balances, student debt burdens. The machine is not abstract. It is the background condition of millions of lives. Each gearbox can handle stress for a while. But when all three are stretched at once, the system loses resilience. Section 8. Why it broke without a single moment of failure. When you hear broke, you might imagine a dramatic snap. But the debt machine broke in a quieter way. It stopped self-correcting. In a healthier system, excesses are corrected by failure. Bad investments fail. Over-leveraged strategies collapse. Risk is repriced. The system resets. In the debt machine, the reset is postponed. And each postponement changes the baseline. The system becomes trained to expect the postponement, which means more strategies are built on it, which means postponement becomes even harder to withdraw later. This is how you get an economy that can look strong, rising markets, steady employment, while carrying growing fragility underneath. The break is not an event, it is a transformation. The machine still runs. It just requires more support, more debt, and tighter control to keep it running smoothly. Section 9. The human cost. Why Americans feel stuck. If you want to understand why this story matters to Americans, look at how people feel. Many Americans feel they are running faster and getting less. They feel priced out of housing. They feel savings do not grow the way they used to. They feel that doing the right thing does not guarantee stability. That is not only cultural, it is structural. A debt-driven system tends to lift asset owners first. When credit expands, asset prices can rise faster than wages. That creates a gap. Those who already own assets benefit. Those trying to buy in fall behind. Over time, the economy can feel like it rewards timing more than effort. Meanwhile, the machine needs constant activity. It needs spending, borrowing, refinancing, and confidence. When confidence breaks, the pressure flows downward. Tighter credit, higher costs, reduced opportunity. That is why this is not just an investor story. It is a household story. Section 10. Connecting to Part 1 and setting up Part 3. Let's connect the trilogy clearly. Part 1 explained the setup. How repeated rescues train the system to expect stabilization. Part 2 explains the engine. How that expectation turned into a debt machine that powers normal life, and why the engine now creates fragility as a byproduct. Part 3 will show the consequence, what happens when confidence weakens and liquidity hesitates. And here is the key point, it will not start with panic. It will start with hesitation. Lenders become cautious, institutions protect themselves, markets reprice risk, funding becomes selective. The machine, which depends on smooth refinancing, begins to stutter. The public may not notice at first, headlines may not scream, but the choices narrow quickly. That is why modern breakdown feels sudden. It is not sudden. It is simply hidden behind normalcy until it cannot be hidden anymore. Closing America's debt machine was built to survive everything. And for decades, it did. But survival trained dependency. Dependency created fragility. Fragility reduced the margin for error. The system is not one shock away from total collapse every day. But it is closer to constraint than most people realize. Because when your economy is powered by debt, the question is not whether borrowing will continue. The question is what happens when the borrowing cannot. In Part 3, we are going to trace that moment. The silent breakdown, the near collapse that looks like ordinary news until it suddenly isn't. And once you see the pattern, you cannot unsee it.